Right, good morning to our wonderful audience once again, and welcome to Boutiques on Wednesdays. 2 more days and it's officially spring season. What an amazing time of the year. Let's hope the same goes for markets. Today we will have a closer look at the Select BCI Enhanced Core Range, which is a low-cost savings or low-cost investment solution range. Joining us this morning to moderate the session is Managing Director of Boutique Investment Partners, Pierre de Klerk. BIP is one of the top investment consultants in SA, offering intermediaries like yourselves a wide range of investment solutions and services. Good morning, Pierre. How are you?
Good morning, Eugene, and thank you very much for the opportunity. Can I take over?
Yeah, you can introduce the session and what we are going to talk about today.
Thank you very much. Thank you, Eugene, and we are joined by Chris Rule from 10X. We're very happy to have him this morning. Ourselves at BIP has worked with Chris's team about 2 years ago to develop a rules-based and passive product range that is really intended to be ideal core solutions to use in portfolios, and we've been managing and enhancing that with Chris's team over the last 2 years, and we're very pleased with the performance and the behavior of the portfolio so far. It's been quite successful and consistently above the peer group benchmarks, which is exactly what we wanted to do as cost-effective core solutions. We started working with them about 2 years ago, as I mentioned, when they represented Coreshares. Subsequently, they did a transaction with 10X, of which we were very supportive because it enhanced the IP depth and the operational depth and scale of the operations that I think is important in the passive space. So maybe, Chris, welcome, and maybe you can pick up the discussion there in your introduction briefly with the Coreshares 10X relationship. Sorry, and I want to add lastly that Chris have done a lot of interesting work on the evolving nature of betas in South Africa, and that's what we specifically asked him to come and chat about this morning. Thanks, Chris.
Thank you, Pierre, and thanks for having us on today's webinar. I think let's take it from right at the beginning. Pierre mentioned Chris from 10X, and I'm sure from our relationship that Pierre's described, you were more familiar with Chris from Coreshares. So 10X acquired 100% of Coreshares. The deal was announced almost 18 months ago, but we only got approval on the 1st of January. And so now we sit as a fully integrated investment team. As Pierre mentioned, a depth of IP in the business is one of the big benefits. So our investment team's gone from 5 to 16, and that's kind of a big lift in terms of focusing on important things in the investment problem-solving world. And scale was a big unlock in the transaction. So the transition is well and truly underway. You may still see some reference to Coreshares. That's a technical FSCA reference. Our Manco is under the process of amalgamating with the 10X Manco, and in about a month or so, we will be totally integrated and completely branded as 10X. So that's all going well. Today, though, importantly, interestingly, my role at 10X is virtually the same. I still head up our client solutions and product part of the business. So I'm speaking from the same perspective. And that's the perspective that we've always been interacting with Pierre and his team in terms of how we built out the enhanced core range with Pierre's team. And we're going to speak a lot about this idea of core and why there's a rationale for using a core, and perhaps why there's very limited use of core from our perspective in our markets. And there's going to be a lot of conversations around divergence, because I think it's very topical at the moment. There's a lot of manager divergence. There's a lot of divergence in asset allocation given liberalizing Reg 28, and therefore the challenges that it poses advisors and multi-managers in terms of how you select managers, how you populate your asset class building blocks, or how you indeed select a multi-asset framework that could be substantially different in 6 months or 3 months and so forth. So thanks, Pierre. I'll kick off with the preso, and it's once again, it's fantastic to be here. I am assuming we can all now see the presentation. Pierre, will you give me a thumbs up just so? Okay, there we go. Fantastic. Yes. So Great, thank you, Pierre. So as I mentioned, we're talking about the enhanced core range, but we want to take a step back and actually look at some of the key drivers behind the allocation to a core type building block or a core portfolio. The first rationale is typically when one looks at a core strategy and one considers some of the challenges of manager selection, core delivers a consistent outcome. Now, this is the SA general equity category, and this shows the divergence over a 1-year period in returns. And what's very interesting is that if you take the lowest return at minus 6.2% and 24% is the highest return, there's a 30% divergence from top to bottom in the SA general equity category. Now, there's a lot of factors driving this. We know that there's a lot of concentration in our market. There's the ability to use offshore inside of the SA general equity category, which in a sense muddies the water from a comparative perspective. But the reality is that when one is selecting a local manager and one is selecting an equity building block, ultimately it's modeled on an asset allocation which references a beta, and you need that allocation to deliver something as close to beta as possible, and you know, if possible, to drive out performance relative to that. And obviously that's where Pierre and his team come in. They're looking to select best-in-class managers, and that's where they are holding you know, everyone's hands and ensuring that they don't end up buying the managers at the bottom end of this divergence. Now, this is something we don't just observe over this last 1-year period. This is something that we've observed over many periods of time. This is a 3-year period. You see in total cumulative returns, so this is not an annualized figure, 139% of return divergence between top and bottom. Now, that is a substantial difference in your outcome if you say picking a manager to populate your SA building block, and potentially there's all this outperformance on the table, but realistically there could be a lot of underperformance. I think what we're looking at here is the challenge of selecting managers and ensuring that your managers are on the top quartile or above the peer group average. And the peer group average here is this dark blue line. I'm going to flip back one slide. Over here, it's this gray line over here, 13.3. And what is interesting to note is the consistency of these core allocations relative to the average. So it's the idea that when you make an allocation to, let's say, all share, that you're just accepting the average, is something that we've been trying very hard to sort of debunk and ensure that people are, and allocators of capital understand that an allocation to beta is not an average allocation. It's actually on average substantially above the peer group average. And there's a whole lot of reasons for that. There's the theory of zero sum, where, you know, investing is a zero sum game, and so someone who wins, there must equally be someone who lost. And then if you layer costs over that, then on average, if you take the average and you take the average winner and the average loser, you get an average that is below the market return. So there's good economic rationale behind it. But really the practical challenge is you just don't want to get caught out picking the manager who's right at the bottom of that. And the consistency around this is quite substantial. This is beta. This is a piece of research that Spiva does, and Spiva is the S&P index versus active. They do this every year. It takes into account survivor bias, so it's well scrubbed from a data perspective. This just shows the consistency of beta relative to the active market. So this uses a top 50 S&P top 50 index. It's an index that we use widely across our business, and you can see this number, 85%, then 91, then 75. That is the number of active managers in that SA general equity category that underperform the S&P SA 50. And that is a substantial number. And this is over a 5-year period. And you can see the absolute consistency through time. So this is all great. And you're probably thinking, well, this is not surprising. Chris has always been talking about passive and talking about index-based use, and these guys are always beating the drum on consistency. The reality is, why has there been a low uptake of indexation in our market? And that's actually what we want to talk about. We want to talk about our SA equity market. We want to talk about the history behind it. And we want to talk about the relative low uptake and why potentially there's a good case for more uptake in the future. So this is the ultimate problem. And I'm going to go on a bit of a storyboard here, so please excuse me for a bit. But if we roll back 25 plus years in the SA equity space, we didn't have the FTSE JSE indices that we all reference now. We didn't have the all share and the top 40. The index was actually calculated by the Actuaries Association of South Africa. 2002, the FTSE and the JSE did a partnership, and they established the Africa All Share Series. And that kind of set the scene for indices that were, more widely accepted and that were more widely referenced and benchmarked from a manager perspective. And so in 2002, the introduction of the All Share was quite a sort of significant move in the index landscape in our markets. And ultimately what happened was, because of the market dynamics, and I'm going to go into some detail on the market dynamics, but because of the market dynamics in our markets, the all share became very concentrated. Now, this is not a new story. We know that. We know that our market has become concentrated at particular points in times. We know that like Naspers, it was hot on everyone's lips 5 years ago, more recently Richemont. But our market at that point in time was extremely concentrated in some of the resource counters, in particular BHP and Anglos. And so at that time, the institutional market got together. This is the pension fund buyers. And they said, we need to, create an index that is more diversified, that's not as concentrated, and be more liquid. Because what had happened was we had a large proportion of dual listed companies on the JSE that, although referenced the total market cap from a liquidity and trading perspective, the equivalent liquidity wasn't referenced in the market. So it came about the SWIX index, which is now widely used. And that kind of divided the market at that point. Suddenly you had users of SWIX, you had users of all share, and then you had users of top 40, and then the capping came in and so forth. And so the SA equity market, from a benchmarking, from an index perspective, got extremely messy, extremely noisy, and in our view, extremely challenging to position a simple index allocation. You go to the US markets, pretty much talking about the S&P 500, the same in the UK, you talk about the FTSE 100, makes an allocator's job far easier, and the justification for allocating to index is much easier if there's only one referenced index. So again, why is this a problem? Well, the problem is there's not just return, well, there hasn't just been return divergence in the SA general equity category. There's been substantial return divergence. I'm going to flip back to that slide in the difference between SWIX weighted and free float weighted. And this all comes back to one big story, and it came out in about 2011. The Reserve Bank was grappling with prudential limits, and they were grappling with prudential limits because in the late 90s, a large number of our large, deeply entrenched SA corporates went and changed their JSE primary listing to London Stock Exchange, predominantly an LSE. There was also the Swiss Richemont listing, but predominantly offshore primary listed counters. Now, typically in the index world, when you're putting together an equity benchmark, you would completely leave those shares out of the index. So Anglos, at the time SAB, Richemont, BHP Billiton, all of those counters would actually just be completely left out of the SA equity index. And there was a recognition that that could be a problem from a liquidity perspective, from a legacy perspective in our markets. So in 2011, the SARB said, okay, we're going to create a rule. It's called the grandfathering exemption. Any shares that are inward listed and secondary listed on the JSE are allowed to maintain their full market cap. But post 2011, any shares that are inward listed and secondary listed can only use the number of shares that are listed on the JSE, which is taken from the straight register. So there was this kind of division that happened in 2011. And suddenly you had SA equity looking vastly different in the SWIX and the all share. And the rule that came down was, when indexes are being calculated for these exempt companies, you use the full market cap, and for indices, this is important because it's not a Reg 28 piece. For indices being calculated post 2011, if something comes in and it's secondary listed, then there's no exemption. You can only use the SWIX weighting, and you'll see why it's topical now, because there's been a lot of change in our in our market. But this has created a very unusual divergence in beta, very unusual market difference between SWIX and all share. The difference is not academic, it's substantial. So from a return perspective, this unpacks the excess return of being long the all share and short the SWIX index. And you can see there are times in the cycle where if you had just chosen all share over SWIX Aussie, which most of us think is a nonchalant, kind of irrelevant differentiation, you have a 7% annual difference in returns. So there's a substantial difference in the outcomes of buying just the all share or the SWIX all share. And the confusion in the market is, well, most people think that's kind of the same thing. So you get these substantially different outcomes. Now, this is driven by a massive differential between the two underlying shares and the weights of the shares in the market. So again, this looks at the active share between the all share and the SWIX all share. Now, it's a bit crazy to think that this is between our two headline standard indices. Active share of 24, 25% on average over the last 15 years, odd. Like to contextualize that, and Pierre knows this work a lot better, but an active manager with 25% active share is relatively active. That's a relatively large active bet. Very high conviction gets closer to 50% active share. But this is an active bet that suddenly allocators are making when they're choosing SWIX or all share. Now,
Chris,
yes,
maybe you must just briefly say what active share means, the definition for active share
absolutely.
as a measure of difference.
Yeah, thank you, Pierre. So active share, what it does is it takes one portfolio and it compares it to another. And it takes the weight of each individual share in portfolio A and minuses the weight of each individual share in portfolio B, and then takes the difference. So what it measures is where is there no overlap in this portfolio? Where is there substantially no commonality between the benchmark and the portfolio? And so what you can see here is that if you take the free float portfolio, the all share versus the SWIX all share, there is 26% of that allocation. There's no commonality between the two portfolios. And that is a substantial difference. But what's interesting, and of course, that's what's driving this big return difference. That's how you can have between two indices, between two standard indices, 7% return difference in 1 year. Now, what's really interesting is what has happened in the last, let's call it 12 months conservatively. And what's happened is the active share has gone from, let's say on average, 25% right down to 9.5%. Now, this is very simply explained in our concentrated markets through a number of shares. So remember, all the way back, we spoke about these dual listed shares and the secondary listed, or the Rand hedges. People talk about Rand hedges, the SABs, the BHPs, the Anglos, the Richemonts. These shares over time have either been bought out, SAB and AB InBev, that was the transaction in 2016, where post that transaction, when AB InBev listed on the JSE, they were only allowed to use their SWIX weighting or their JSE listed share register. They weren't allowed to use their total share register anymore. So SAB went from a substantial weight to the JSE because it was counting both the London Stock Exchange listing and the JSE listing to a substantially smaller weight in the JSE with AB InBev, which is still listed in our market. And that's why AB InBev suddenly stepped right down. It was just a technical exemption. And suddenly SAB, which then became AB InBev, went from high single digits to almost 0% in the index. The same happened with BHP. BHP did a big restructure last year. Their grandfathering exemption fell away, and they went from a weight of 12, 13% in our indices to 2-3%. Richemont's really interesting. Richemont is a depository receipt, wasn't even a share. So in no ways it should have really been in the indices in the first place. Richemont restructured. Richemont went from north of 20% in the top 40 to about 3-4% in the top 40. Now that shows the substantial difference in the weights, and that's what's been driving this differential between shareholder weighted and all share indices, SWIX and all share. Now we think this has been a massive problem for the passive industry for index allocators, because you create one of the biggest benefits of allocating to an index is the simplicity. You just want to allocate to an index, you want to own the market, you want beta. But by introducing these substantially different betas, we've created confusion, and I believe we've created an unnecessary hurdle in the allocation to a core allocation. So the good news is that these indices are converging. They're virtually becoming the same thing. And so the allocation to beta is one that is a more simplified decision. It should be a simpler decision. I guess the point here is to say on this graph, notwithstanding all the divergence of beta, it's clear that a low-cost allocation to a beta, SWIX, all share, has been a good investment, has been a good allocation. If one compares, this is just a cumulative return relative to the all share. But on 5-year rolling returns, you see the consistency of betas. So in summary on this confusing core allocation, and probably everyone's sitting a little bit, what on earth is going on? I think the good news is beta is more simplified now. Beta has historically been unnecessarily complex. It is now a simpler decision. It is equally more consistent with an allocation to SA equity, and this comes at a time when we see Reg 28 liberalizing. So a lot of the necessity to allocate to dual listed companies in our market, the SA Rand hedges, was because of a constrained Reg 28. We now sit in a substantially more liberalized Reg 28, which means SA Beta should be SA Beta, and for global allocations, let's look for purely diversified global allocations. That kind of caveats us into the next components of this, and brings it home in terms of the two sort of main building blocks in the enhanced core range, is looking at the multi-asset landscape in light of a liberalized Reg 28. So at the same time, there's been all this convergence of beta, and on a forward-looking basis, statistically, we can see that betas are getting more similar, the decisions getting simpler, the core allocations getting easier. With the liberalizing Reg 28, asset allocations are getting more divergent. The potential for asset allocations to be substantially different in the high equity category, for example, is much higher. Now, this comes from a sort of a historic legacy, excuse me, with my voice, a historic legacy where, because of our constrained Reg 28, if one looked at the multi-asset categories, there was a lot of clustering of managers around particular asset allocations, because in a sense, it made asset managers' life simple. You just pushed your limits. You effectively just capped out at your capacity where the regs allowed, and then the rest was based on your individual building blocks. Now we've got divergent views on, should we go to 45% or should we be at 35 or 30, and we're going to get substantially different outcomes. And this highlights the importance of strategic asset allocation, where strategic asset allocation ultimately drives outcomes. Now, this is an illustration of how important asset allocation is. This is kind of seminal research which has been repeated and reviewed and constantly updated. And what it shows is this is 120 years of returns of asset classes and what we can expect at a real return, so after the effect of inflation. And this is within a multi-asset portfolio, what actually drives outcomes in the long term. And what is evident here is that asset allocation is the main describer, or is the main variable that drives returns in a portfolio. And it can explain something close to 90% of return variance in a multi-asset portfolio. So what that means is that the focus on security selection, market timing, which is effectively tactical, and other factors have become very close to irrelevant in the decision inside of a multi-asset portfolio. So this is interesting, because now we've got asset allocation, which could be, again, extremely divergent. So this is the last 3 years. This is the Forbes Large Manager Watch. So this is all the big managers. Again, this is like one of these divergence charts. You can see The returns here, over the last 10 years, 10.9, best in class, 8.4. Okay, now we don't want to be at the bottom at 8.4. That 3 odd percent is quite substantial, but relatively tight clustering of returns. And this is we believe is a function of a number of things, but in a sense, Reg 28 and the constraints. If we have a look at the 1-year view, and of course, there's a lot more noise in 1-year returns and all that. So this is by no means like conclusive evidence, but we see suddenly a substantial variation in return in that same high equity category from the large manager watch. And what's interesting about the large manager watch is that this is all the large names we know. This is not like the whole category, because in the whole category, like you can get some very small managers and random managers that create noise. This is all the well-known large managers. So over the past year, up to 31 May, if you pick manager at the top versus manager at the bottom, there's a substantial 14% odd difference in returns in the same category of multi-asset. And this is reflective of that liberalized Reg 28 process. So to conclude, and we're concluding on kind of some of just the conversational topics, which I think Pierre will pick up on. We want to go and unpack why we think the enhanced core multi-asset portfolios should hold a substantial weight in one's portfolios. But to conclude, we see beta converging and multi-asset diverging at the moment, which is a positive and B, potentially problematic, but certainly something we need to keep our eye on in terms of multi-asset divergence. Manager risk from this divergence, manager selection risk becomes substantial. So using Pierre's capability, for example, to help you with manager selection, or indeed a core allocation, becomes a really important consideration to control for manager risk and to control for asset allocation outcome. So consistency that's driven through an asset allocation driven framework is important, because it then enables you to match your client outcome with the portfolio solution. And in a sense, the Select BCI Enhanced Core range is trying to create a core building block within either your multi-asset framework or in your equity space that delivers consistency and anchors one to a particular asset allocation that then therefore delivers a consistent outcome. And you can see that in some of the numbers that we're going to talk about. I see I've got 3 minutes, Pierre, so I'm going to try and get through it so we can do Q&A. So the core range, and there's 4 portfolios. We're going to focus on these multi-asset portfolios just for a few minutes. These are 2 equity portfolios. They are multi-factor portfolios. So this looks at different styles of investment, value, growth, etc. Looks at harnessing those, holding them through time. And these are actually used inside of these enhanced core portfolios as alongside beta to control for consistency around the particular beta. So the enhanced core range looks at a strategic asset allocation framework. Why do we have a strategic asset allocation framework here? Well, it's to deliver consistent outcomes. It's to ensure that we match the long-term driver of returns with the end objectives. It effectively creates an asset liability matching or a client outcomes matching. These are portfolios that are intended to be well diversified. This reduces the risk of underperformance, and it reduces it because one diversifies away specific risk, idiosyncratic risk. So risk that one doesn't necessarily want in your portfolio, and it's using mostly index funds and broad market exposure to diversify. And alongside that, in the SA equity building block, I'll have a quick look at that. It uses different return drivers to enhance the outcome, and hence the enhanced core range. And of course, all of this, what's very important, is wrapped in low cost. Morningstar's got some fantastic research. Morningstar's, globally one of the largest research houses in the fund markets. Their research, even they've got their famous people, process, philosophy, etc. Parent, that the 4 Ps, but they did a whole lot of research that said actually what's the most important thing is the cost. So cost is the single largest determinant of the fund's future success. And that's not active or passive, that's just cost. So if you can buy active at low cost, that's very important. rather than buying active at very high cost. And so managing cost is critical in delivering the outcome. It's critical in ensuring that portfolios consistently deliver on their outcome. And this is the enhanced balanced portfolio, the enhanced core balanced portfolio, which has a strategic asset allocation. The SA equity block is a combination of just simple beta, free float market cap weighted, and multi-factor, as is the global equity slug. So there's a blending there, and there's a diversification element that pulls through here, but well diversified across all of your asset classes. It's quite a lot to consume here, but you see all the asset classes. And what's most important is that the idea here is to create consistency. So what Pierre said is why they're happy with returns. I think what would make Pierre, and Pierre, please cut me off here and tell me I'm wrong, but I think what would make Pierre more happy in this portfolio is if it was consistently above the peer average, not being like top decile and then bottom decile and top decile. So that consistency piece is extremely important. We shouldn't expect to see these portfolios number one of the high equity category, but what we should expect to see is consistent above peer group. And the reality is when you deliver consistent performance like that, and it's interesting, if you go and look at most of the strategic asset allocation, multi-asset portfolios, these are top quartile funds over long term, because that consistency of short-term performance translates into long-term top quartile performance. Of course, there's more information available on these funds, so we can unpack it. And it's the same story with the low equity fund. You can see a consistent above peer performance driven through asset allocation with blending of simple beta and other return drivers like value and growth and momentum in both of the equity blocks, and healthy allocations to income and defensive asset classes here, where there's not just the application of passive building blocks, but also allocations to active income managers inside of this portfolio. And that's extremely important in a low equity exposure, because some exposures are simply not indexable. So we need to get that exposure, in particular the SA credit, the corporate space, and the cash plus kind of category is very difficult to index. And so rather than trying to be binary, this is either active or passive, actually what Pierre and his team have done is very intuitive, and they've built in an important cog of return delivery and defense. So that kind of that sums it up. I think to summarize, I think the idea around a core range like this is that allocators of capital for clients' portfolios create more consistency with their client outcome. They have more line of sight in terms of strategic asset allocation, and understanding that the strategic asset allocation is not going to drastically move in the next 6 months and therefore mismatch their client outcome. And importantly, that consistency is all wrapped up in a low cost strategy. And that's the overarching principle. Yeah, that's it from me. I don't know if we've got any. Once again, thank you for your time. I'm three minutes over, Pierre, so apologies.
No worries.
Apologies for my
Thank
voice.
you.
But, the good thing about a webinar is that I don't have to feel like I'm getting everyone sick. I'm on a heavy course of antibiotics at the moment. So
very true. Thank you very much, Chris. It was interesting, and it raises interesting kind of concepts to think about. And I want to pick up on some of them in questions that I've jotted down. But to start off with, there was one question that came in from the audience, which is half a statement and half a question, but I think it's nice and provocative. So let's start with that one. And the person says that the slow uptake of passives in South Africa has a lot to do with kind of the halo brands and the popularity of star kind of investment houses in South Africa on the active side, combined with the list platforms that are quite kind of restrictive and protective as to what they prepare to allow and not, and basically kind of shielding out some of the passive providers. So I think, you can comment on that, but I think that's maybe kind of some controversial commentary. But then the question part is really the costs and so forth in South Africa of the passives are not quite down to global standards, you know, and thinking of Vanguard and State Street and BlackRock and so forth, you know, are we ever going to get there, or is there some structural issues? Maybe a comment on that.
Yeah, thanks, Pierre. I mean, I think I totally agree actually with the first comment. I think, you know, we've had this confusing beta environment. No one really knew what was going on. And then B, you had these really strong brands and brands. And make no mistake, those managers produce good outcomes and good returns for clients as well. So it wasn't just brands, it was good outcomes. And then the list, you know, one of the mistakes that the providers of index-based strategies made, and we made the same mistake at Coreshares, was to go at it in the ETF market first, and then therefore completely lager yourself out of the LISP distribution network, which is the most powerful distribution network. And then again, the LISPs are owned by those incumbents who are protecting. So I think that there's so much in this mixture, but that's absolutely valid. On the cost side, I think you're right. I think our costs are probably on average higher than, let's say, the US, as an example. I think what is often misconstrued, though, and this is where I like to create a distinction, is the idea that all passive globally is single-digit basis points. So I will, you know, S&P 500, you can go buy at low single-digit basis points, 5 bips, 7 bips, 3 bips, no problem. The minute you step out of the S&P 500, you're into the teens and the 20s and the 30s. And an example that's useful to use is, okay, so let's start there. So if you look at the US, you can go buy S&P 500. If you look at our market, you can go buy the top 40 at 10 bips. TIC, by the way, we're ahead in the reporting standards. Globally, it's typically just TER that you're looking at. So TIC, you can go buy top 40 at 10. So there's 5 points in that. The real drivers there are, of course, the scale. That's the big elephant in the room, is do we have enough scale to get costs down to the US market? I don't think we do. I don't think we should be trying to package up 5 pip SA equity funds. You know, there's probably not sufficient scale to justify that. Step out of the US, step into the UK, you're buying like UK exposure. The cheapest you can get is 8-9 basis points. So it's kind of starting to get close to us. And then you go into EMs and DMs. So if you compare us globally and not just to the US, I think we're pretty much on par with where we should be. And that's just natural market forces getting us right. The one example I like to use is one of our global ETFs that we run, the Coreshares Total World Stock ETF. We actually just feed into Vanguard. Now we go and buy Vanguard in the US, and we've got a tax dispensation between us and the US. So we've got the 15% tax back. So it's quite efficient from a tax perspective. Now that thing comes in at a TIC of 29 basis points. If you go into the Irish UK market, you cannot buy that same exposure cheaper. It's cheaper in our market than it is in that market. And that's there's a number of things there. There's the tax and all that kind of stuff. But that's an interesting comparison, because we're able to, the US is so cheap that we're able to go buy one of their funds, put in a management fee, wrap it, and you can't go and buy cheaper elsewhere. So that's an interesting comparison. But I think as the market scales, as businesses are allowed more breathing room, you could see margin compression. The multi-asset space is actually very competitive, if not more competitive than the global multi-asset categories. So it depends what you slice and dice.
Thanks for that. I actually want to extend that last question, because I'll read it. What the person wrote was TE, capital T, capital E, not as low, consistent as foreign mega players like Vanguard, State Street, BlackRock. So I interpreted it to refer to total expense, but maybe it actually can refer to tracking error. So maybe you must comment about that as well. You know, the success of tracking an SA on a tracking error basis versus the mega players.
Yeah, I think if you look at like SA equity versus US equity, for example, our tracking's on par. Where there's tracking noise in our market is on the currency translation, and that it creates a lot of noise. So the way that, let's say, an S&P 500 prices in that market is on close, the index price is on close, and you get a neat tracking. The minute you translate it back into rands, you get noise around the tracking. So that's misconstrued. So for example, when we go and buy Vanguard, which to your point is like best in class tracking, we get tracking error, but it's just noise around the current currency translation of unitizing the product back into rands. So look, if you're looking at like a global equity tracker, the scale that a Vanguard has relative to us is substantial, and then therefore they should track better. But if you look at local equity bonds, etc., I'd say we're on par.
Cool. Thanks. Let's return a bit to the concepts that was raised in your presentation. So to simplify it quite materially, you mentioned that the betas are converging. Let's say that the all-share and the SWIX is converging effectively. So that decision is becoming easier. But you also said that a fallout from this is that the local content is actually being pushed up because there's less rand hedge exposure. So the question is, there's obviously lots of factors that feed into one's decision about your level of foreign exposure. But just isolating this topic, how big a difference is this going to make? Does it imply that all else equal, one will have to add 5% or so to your global exposure just to compensate for this kind of domestication of the SA equity beta, if I can call it that?
Yeah, I think, look, if one takes a classic framework of equities inside of your asset allocation framework, you're looking at SA equity at less than 1%. So any bet above that, like outside of an asset allocation framework, is a substantial one. So the trade-off there is then therefore the additional risk for taking a concentrated bet on a market like SA relative to the return. So if you look at that, if you turn the whole thing around and look at that as a starting point, well then SA equity should be getting reduced and global equity should be replacing it. The reality that there's less rand hedge components in our market at the moment is one, and so then therefore to complement that with more global equity, which we can now through the liberalized Reg 28, makes a lot of intuitive sense. My one word of warning on these like broad sweeping, like I'm going to say there's less equity, that can change, right? I mean, and there's no control over that. The only control over that going forward is that for indices, we must use the SWIX weighting. We must use the straight register. So the only control is that at least the liquidity matches it. But, we live in a globalized economy, so things can change. We could have a South African telecoms company appear that suddenly becomes a global player, and that changes. You've got to have constant look through, constant eye on the ball on that assumption.
Well, thanks. Let's talk about the US quickly and your observations about investor behavior. The S&P 500 have done quite well this year to date, but there's lots of interesting graphs being shown how it's probably almost exclusively being driven by the Magnificent Seven AI-themed related tech shares, and the other 493 shares have really kind of bottom dwelled. So the question is, what do you observe in terms of what investors are saying and what you're seeing internationally and locally? Are people chasing the S&P 500 returns as if it is the gold standard, or are people saying, listen, it's very narrowly driven, valuations in certain pockets of it is very toppish, let's rather look at alternatives like the RAFI, which is kind of factor-based, or the equal weighted S&P 500 that mitigates against a bit of what we're currently seeing in the S&P on a forward-looking basis. Are people chasing, or are they rethinking?
I mean, this is just an observation from my engagement with the market, but I do think people are rethinking. I think if you look at the CAPE ratio, which is the cyclically adjusted earnings price earnings ratio of the S&P, it's right in the top decile of where it's ever been, and that implies a poor forward equity return in that market. And so I do see people hesitant around that, and what you're seeing in the main is a shift. The first shift that we've seen is most people exclusively index themselves and benchmark themselves to MSCI World globally. That's changing to ACWI. So effectively, replacing some US exposure with some emerging markets. So actually at a geographical level, I think that's been the first step, is to incorporate emerging markets and potentially upweighting other markets. We've just actually launched, for example, an Asia Pacific fund, because we think the market's looking for exposures that aren't just heavily concentrated in the US. And then interestingly, I have in our interaction with the multi-manager and DFM market, there's been more and more talk about investigating small and mid-cap US managers. So this is not necessarily index allocations. Actually, we've heard of guys going out to find a US mid-cap manager or small-cap manager so that they can diversify away some of that valuation risk that exists in the S&P 500. And I mean, just anecdotally, I'm not sure if you've seen this, Pierre, but you know that the NASDAQ had to cap their index recently. So this capping thing is not just an SA problem. It's a global problem. The concentration is a global problem. It always has been. If you go back in time, the average rule of thumb, like one of these principles, is that 20% of the shares represent 80% of the market. That's kind of the motivation for equal weighting and factors and stuff. But that's pretty consistent through time. Now you've just got like 5% of the shares representing half, let's say. So yeah, it's interesting times.
Thanks a lot. We're basically at time, but there's a last question that came in, which I think has a lot behind it, but maybe answer it very, very high level. And the question is really, how has the sector exposure of our market changed? The question says All-Share and SWIX. How has that changed over the last 10, 20, 30 years?
Yeah, so I can do that very quickly in like a high level response. All-Share typically was overweight materials and underweight financials. So the All-Share exposure was typically concentrated in material shares. And that was because of BHP Billiton and Anglo's. Literally, those two shares created that concentration risk. The SWIX, on the other hand, was typically overweight financials because those were the big SA Inc. companies, in particular the banks. And then in recent history, the All-Share has been overweight consumer discretionary. Now we say that's like a sector overweight, but it's actually Richmond. It's just one share. So with that restructure, that's neutralized. So the predominant sectors in our market through time have been materials and financials. Those are the kind of big concentrated sectors. Recently consumer discretionary, but that's a Richmond thing. And Naspers was once a consumer discretionary, it's kind of moved. But those have been the big exposure. Those are neutralizing relative to each other. So they're getting more similar, but we still do see our market through time with large materials, resources, exposure, and financials. Those are the kind of dominant sectors.
So is it true to say that where we are now, from a risk point of view, our market is let's say better diversified from a sector point of view compared to what it was historically?
Right now, yes, because we've got less concentration in materials. But who knows going forward? Because
yes. Of course.
Cool.
Thank you, Chris. Thank you very much. We passed quarter past the hour, so I think we need to conclude. But it was a really interesting discussion. If we have more questions coming in, I'll forward that to you to answer. But thank you very much for your time. Thank you for the work you've done for us on the core range. I think those graphs are telling that they are doing the job that we want them to do. Thank you for the insights offered.
Pleasure. Thank you, Pierre.
Thank you, Gene.
Yeah, Chris, thank you so much for that. That's been absolutely interesting. Obviously, lot more to it than one would have thought. To our audience out there, the Select BCI Enhanced Core range is available on most of the big platforms. They can actually get hold of it. Low-cost solutions if you are looking for that core stabilizer for your clients. We don't have boutiques on Wednesdays for September because we've got the live road shows where we will see you in Johannesburg starting the 6th September, Pretoria 7, Durban 14, and Cape Town 20 September. Really looking forward to seeing you all there. And again, thank you to Chris and Pierre for very interesting conversation on the Select BCI Enhanced Core range managed by 10X. Thank you so much for that. To our audience out there, we'll see you at the venues. To the BCI team, thank you for setting up your sessions, and we'll see you at the live venues. Thank you.